Let's now look at targets. Well, we have the RSI rising, stochastic rising, and it's holding above an inclining slow moving average. As long as this moving average is inclining, the market is still in an uptrend. What are the targets that we're looking at? Very short term, we're looking at this gap to get filled at 449.5. That's very short term. These nearly always, guys, lead to turns in the market. As of right now, we have this sizable bullish divergence, or I should say just a divergence between the Dow Jones Transports down below and the Dow Jones Industrials up top. Welcome back, you legends. I'm Dr. Cal, and that was a quick rewind from yesterday's key market update video. We discussed a lot of things, including where the market is going next in the short term and medium term. I covered a lot of major technical indicators. If you watch the video till the end, you will not have missed those critical targets that I discussed yesterday, including the gap fill target at 449 on the SPY, leading into CPI this upcoming Wednesday morning. So congratulations if you caught that. Just a week and a half ago, we were talking about a pullback that was imminent as the market was actually forming this top. We said that we expected the market to rally slightly from 451 to 453 on a better than expected PC, then produce a sell-off. Miraculously, we got exactly what we were expecting. We had that slight rally, that bearish divergence completed on the 1 hour chart. SPY made a slightly higher high as the RSI made a lower high. That established that bearish divergence that led to the sell-off. We expected a sell-off to 445. We got that pretty much on the dot. Look at this, guys. Price is now hugging this slow moving average, the purple line. As long as that line is inclining, the market is in an uptrend. Today, we held all of the key moving averages. In fact, we recovered the slow, the medium term, and the short term moving averages. Price action is now above all of these. We also completed an island reversal pattern. This is the island double bottom, both hitting that key moving average with a gap up to start the day. Why did the market gap up today? Well, it's because of key economic data that came out of China in the weekend. Now, economists believe that China's economy is actually bottoming and is recovering. So China is coming out of the slump, and this will drive a lot of global economic activity and currency activity in the markets, which is overall bullish for the S&P 500. In the short term, we said we were looking at a gap fill of 449. We came within 20 cents of filling that gap. Today at the open, we had a gap up, a sell-off, held at the 5-day moving average. This is a perfect, guys, gap up, a backtest of a key moving average, then a recovery. This setup now objectively looks significantly more bullish than what we had ending the week Friday. And I talked a lot about this in the last update video, guys. There are a lot of bearish sentiment that I'm reading in the comments on YouTube, on Twitter. Retail traders seem to be still looking to short market tops when in fact we're still in a short-term uptrend. That is an exceptionally risky strategy. As long as the market is trending up, we want to be buying the dips, and as long as the market is trending down, you want to be shorting the rips. Or simply, if you're risk averse and you don't want to short the market, simply stay out of it. Just hold cash, wait for that pullback to complete, for the sell-off to be done with, and then buy these gorgeous dips. We've been taking advantage of all of these dips, guys, adding to core long positions. By the way, guys, I share all of my trades and investments in real time in the trading community, as well as my weekly watch list, weekly expected moves for more than a dozen different products, including all the major indices and all major tech companies. And I share my favorite tradable and investable setups every week. This morning, I shared one of my absolute favorite bullish bottoming setups in a key stock that we've been watching for a long while. If you're part of the community, you know exactly what I'm talking about. You can find all of that, legends, in the link in the description below on our Patreon page. Also, legends, please tell me if you've been enjoying the rewinds at the beginning of the video to recap, to really build on key market observations. and forecasts, tell me in the comments, legends, because they take additional time and editing to get done. So if you legends appreciate that format, slap that like button right in the face and tell me in the comments. Also, if you don't like them or you don't find value in those recaps, also tell me in the comments because I can skip them entirely and it would save me a lot of editing work and a lot of time. Okay, so we had pullbacks every single time the RSI hit 77, and we had the pullback actually bottom and end every single time the RSI dipped below 50 and then recovered, dipped below 50, and then recovered pretty much every single time. Now the RSI is above 50, it is rising, the stochastic is also rising. We're above all key moving averages on the hourly chart. What are we looking for next? Well, we're still looking for this gap to get filled at 456. That is not likely to happen until and unless CPI consumer data comes out Wednesday below expectations or meeting expectations. The market is waiting for that key fundamental catalyst to be on the bullish side to continue this uptrend, making higher lows and higher highs. So we're still waiting for that key data. If that key data actually misses and we hit higher than expected CPI in August, that will be negative for the market and we'll likely see a negative reaction. So what are the levels that we're looking for? On a hawkish CPI, we expect a sell-off all the way back down to 440. On a bullish CPI, we expect these highs to be taken out and a gap fill at 456. Based on everything we discussed in the last video, legends, all the major technical indicators lean bullish. They lean bullish heading into CPI. That does not guarantee anything, but they all lean bullish, which means a higher high is more likely than a sell-off. Even if we get a sell-off to 440, that would still establish a higher low and would still keep the door open for higher highs. Let's talk about the VIX, legends. In the last video update, we discussed this key gap at 13, and notice, legends, the market actually rallied and the VIX stayed flat. This gives the market additional runway to rally because we haven't yet filled this key gap at 13. The market is likely to continue to rally until we fill this gap. That again opens the door for higher highs and for this gap fill at 456. By the way, guys, this blue and black chart below is the S&P 500. Up top is the volatility index. They are inversely correlated. Whenever the market is rallying, the VIX declines and vice versa. An exceptionally accurate trend-setting indicator is the VIX. Whenever it is below the 50-day moving average, this green moving average, the market is in an uptrend. Whenever it is above this key moving average, the market is in a downtrend. Recently, we broke below the 50. Went all the way back down to these lows, back tested the 50 again, failed to clear it. 1, 2, 3 tombstone rejection candles with one of my absolute favorite bearish breakdown structures, a gravestone 3 candlestick structure. It is named that because it looks like a gravestone. We have a candle to the left, another candle up top, and a breakdown candle to the right that takes out this prior low. That's exactly what happened, legends. This is the first candle. Second candle made the high. The third candle took out this low and it confirmed the breakdown in volatility. As long as volatility is declining, trending down, the shorts will have a very hard time shorting the market because puts will not be able to hold their value. Let's take a look at the S&P 500 daily chart. On the PPO histogram, we printed a green bar today. The RSI on the daily chart dipped below 50. Pretty much, guys, every single time we had the RSI dip below 50, the market formed a bottom and the pullback ended. As long as the market is in an uptrend, a dip below 50 actually marked the bottom. This is an example. Dip below 50 marked the bottom perfectly. Again, here it is, dip below 50, mark the bottom on the day. Again, legends, at 50, mark the bottom. At 50, mark the bottom. What about here? 50, mark the bottom exactly to the day. We now have this very clear, very clean bull pennant that is forming with a resistance up top, support down below. Support is at 440, resistance is around 452. If we get a breakout above this resistance, this will confirm, very likely, guys, a breakout and a higher high that takes out this prior high. Now, quite often, guys, the way to trade these breakouts is to enter at the breakout or to wait for a back test and then enter at the back test. Alternatively, you can simply open 50% at the breakout and then add 50% at the backtest, because sometimes the market just keeps rallying without ever backtesting. That is all too early to talk about, legends. We have to wait for CPI first, then PPI on Thursday, and the Fed interest rate decision September. So we have three major risk events: CPI this Wednesday, Thursday we have PPI, and next week we have the Fed interest rate decision. If the Fed actually raises rates, I expect the market to pull back. That means one of two things. If we have already broken out, it will mean that we will get a back test. If we actually fail to break out, that will mean that we will go back to at least this support line. And if we break this support line, we will go lower to the next support line at 431 to fill this yet unfilled gap and to test this major trend line. The market will need a major fundamental news event to hit this trend line. Guys, this bottom formed on CPI data. This bottom formed on Fed intervention after the SVB and the regional bank collapsing. A tag of this support line will require a major bearish, I would say, quote-unquote, black swan event. Is that the Fed raising rates next week? We still don't know. What is very likely to help us form an educated forecast in the medium term is number one, CPI, number two, PPI, and number three, the Fed loves to drop hints and leaks ahead of the actual meeting. And the Fed will likely do this again after the CPI and PPI data comes out. Watch the Wall Street Journal. Look for an update from Nick Timiraos. He has direct access to the Fed, and the Fed has actually used him to leak decisions many times before the actual event. So post CPI will very likely get a hint from the Fed through the Wall Street Journal regarding what the Fed decision will be next week. So we'll likely get that move priced in ahead of the actual meeting. So if the Fed hints at a rate hike post CPI, I expect the market to react negatively and to go back at least to test this support line. The Fed remains silent, expect more and more market coiling, and then for a breakout or breakdown on the Fed interest rate decision on September 20th. With all of that being said, with all of those key risk events, CPI, PPI, and the Fed meeting next week, the technicals all lean bullish heading into those events. So we have to keep that in mind. Again, we talked about this bullish divergence that has formed last Friday. We're now seeing a slight breakout in the transports relative to the industrials. This is the Dow theory model. Up top is the Dow Jones industrials. Down below is the Dow Jones transports. To understand how to read this chart, to use it to find bottoms and tops, please check out my last video. I discussed that in detail between the 4 to 8 minute mark. So far, we're getting that breakout, the beginning of that breakout, which is bullish. We have that bullish divergence. And so far, it has actually produced a breakout. Another key breakout today is in consumer discretionaries. Look at this, legends. Higher lows, higher highs. This is XLY divided by XLP. Consumer discretionary divided by consumer staples. As long as this chart is trending higher, it indicates that the market is bullish and that big money is taking risk, reducing exposure to defensive positioning and rotating into offensive positioning. We have a new yearly high today. Look at that. We had a gap up and a breakout, and we can clearly see it on the stock market map. Tesla, Amazon, and Meta all breaking to the upside. Take a look at the stock market sectors. Consumer cyclicals leading, tying in with that data from China, that positive data from China. Let's talk about the fear and greed index. We're at 52 neutral. We're still making higher lows on the fear and greed index. We have made a double bottom in the past, then a double bottom with a higher low. Again, double bottom, higher low. These usually mark significant stock market bottoms. We're still making higher lows and higher highs. And overall, so far, legends, the trend is up and sell-offs and corrections have been met with buyer demand. I know it can be a little bit difficult because the market is dissociating from the key fundamental economic picture in the US and globally. Growth is terrible in the US and abroad. Inflation is still high. All of that is absolutely true, but it takes a very long time for those fundamental key economic catalyst to the downside to actually play out. The absolute best indicator to time that massive recession without a question is the yield curve. So let's do that right now. Up top is the 10-2 yield curve. Whenever we're below the 1%, the yield curve is inverted. Pretty much, legends, every recession in the last 100 years has been preceded with a yield curve inversion, but markets don't actually top until and unless the yield curve begins to steepen again. Usually that steepening marks the stock market top. Usually, legends, that steepening marks the stock market top. And then we get the recession following that. So far, the yield curve is still inverted. It needs to exit inversion, go back above 1%. And at that point, the market will likely form the actual multi-year top. In the meantime, legends, we simply have to trade the charts that are in front of us. And so far, the market has been making higher highs and higher lows. This is the 200-day S&P 500 breadth. It looks at the percent of stocks in the S&P 500 trading above their 200-day breadth. This is the gold standard breadth indicator for the market. And notice, legends, we have a double bottom with a slightly lower low, as the PPO has made a double bottom with a higher low. This is a bullish divergence. Small caps, meme stocks, all of your favorite retail stocks love to rally when this indicator breaks above the 50 reading and is forming a double bottom. It will likely break above the 50 on a better than expected CPI result. So if we get that, expect a lot of big rallies even in meme stocks. These double bottoms, legends, have been key in spotting key market bottoms. Look at this, legends, every single time, including this double bottom with a positive divergence that we actually used and discussed at length when we called the bottom on October 13th. We called that bottom to the day, one day before it happened, leading into CPI, as everybody was looking for a liquidation break, a massive crash. We were actually calling for a bottom, and that turned out to be the actual bottom for this entire Fed interest rate hike-led correction. The big recession crash is still not here. We will likely make new highs before that happens, but it is absolutely inevitable. Again, I discussed this in the last video, legends. Triple top on the CPC money time machine buy and sell signal. This indicator is my own variation. You will not find it anywhere else. All Discord community members get access to this chart. And this triple top, legends, these triple tops in the CPC buy and sell signal always match up with key stock market bottoms. We're now waiting for that buy signal from the CPC on the PPO. We need to see a cross down to confirm a buy signal. That hasn't happened yet, but very likely than not, legends, we will need a bullish CPI to get this buy signal. Speaking of the Discord trading community, this is it. You'll find it on our Patreon page. You need to have a Discord account, legends, because I post all of that stuff on the Discord. After you join on Patreon, simply link your Discord account and you'll have access to our trading community. You can take advantage of the 20,000 subscriber special, 70%, the deepest discount that we ever ran on the legendary membership. If you want to go annual, you have to click pay annually. If you want to do monthly, simply join monthly. Legends, this is identical to the $120 Living Legend membership, so please do not sign up for the Living Legend membership. Take advantage of the discount. They only have 20 slots open, and so far we've filled roughly 16, I believe, so we only have 4 left. So if you've been thinking about joining, this is the best possible time to do it. And with that, legends, I want to close this out with this seasonality from the Almanac Trader. Quite often, legends, September tends to be bearish in the second half, or I should say the last third of the month. These are the trading days below, not the trading dates, the days. So the 13th, 12th to 13th trading days is often when the market tops in September. That happens to coincide with September 20th. Take a look at this. The 12th bar is the 12th trading day. That's September 20th. That's the Fed interest rate decision date. That's Wednesday next week, FOMC meeting and the Fed interest rate decision. So again, even if the market is leaning bullish heading into these key risk events, fundamentals always override technicals. So we have to keep an open mind for both sides, identify those key levels, and react to how the market behaves. Let the charts show you where the market wants to go. We don't want to impose our ideas on the charts. We want the charts to reveal to us what the market wants to do. If you enjoyed this video, legends, slap that like button right in the face. That's the best way you can support me totally for free. If you watched the video till the end and you did not enjoy the video, I do thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.